So far in this mini-series, we've looked at the basics of volume data, the generally accepted underlying principles for interpreting volume, and then last time, the common three-peak pattern. But to use volume data to maximum effect, you also need to understand how volume patterns vary across different asset classes, but also within asset classes. And in this episode, I take the covers off volume data specifically for Forex currency pairs. Stay tuned. So let's now take a look at the way that volume data patterns vary across different Forex currency pairs. So as we saw previously, volume tends to vary throughout the day in regular patterns. And the basic pattern that we looked at was what I called the three-peak pattern. And you can see that pattern here repeating fairly consistently over a 3-day period. However, what we're going to start looking at today is how this pattern varies across different asset classes, but also within asset classes. But why is this so important? Well, understanding how these patterns vary across different assets is the key to successful use of volume data. And if you perform your analysis with these different patterns in mind, it will enable you to make decisions that are so much more effective. So let's start to look at some examples. Now, before I start, I want to explain where I've got this data from. So the volume information that we're looking at here is not just from a single day. It's been averaged out over 22 trading days. So effectively a month. And so the results you'll see on all of the charts I use in my examples today have been calculated using that basis. And so those charts give us a reasonable average idea of the behavior of volume throughout a 24-hour period. So we're going to start by looking at a currency pair where both the base currency and the quote currency come from the same session, so effectively the European session. And so the example I'm going to use is Euro-Pound. And it will help to visualize why the volume changes in the way that it does by overlaying the main trading sessions. So this, for example, is the extent of the European session. And probably no surprises that the volume of this particular currency pair during the European session is higher than it is at other times. And if we now overlay the US session, we can see that where those two overlap is where we get the maximum traded volume. But you'll note that during the Australian session and the Asian session, certainly towards the beginning of those, the volume is much lower. But where this begins to become a little bit more interesting is when we compare it to an alternative currency pair. And the one I'm going to look at is Aussie yen. So here we might expect that because the quote currency and the base currency come from the Asian and Australian sessions, we'd see more traded volume during these sessions. So those highlighted in the red box here. And if I just flick between the two different charts we've looked at, you can see how, relatively speaking, the volume is much higher in these Australian and Asian sessions. However, you'll note that there is still more traded volume during the European and American sessions. Next, let's move on to two American-based currencies. So we'll look at dollar CAD. And what you'll see here is that we still get our three peaks, but here you'll notice that the American peak is almost double that of the European Open. So let's briefly now look at some crosses where the base currency and the quote currency are from different time zones. So the first one, euro-dollar, and you'll notice here that volume is quite high actually in the Asian sessions, but also obviously very high in both the European and American sessions. And then for euro-yen, you'll notice that the size of the volume during the Asian session is now relatively more for this pair euro-yen. So the important takeaways here are that generally speaking, the three-peak pattern persists across all currency pairs. However, the relative size of each of those peaks for the main three sessions varies. And so what are the implications of that? Well, you'll remember that in the last episode, I explained the concept of looking at relative volume, and it was this comparison that gives us an indication of what the commitment is behind a move, and therefore give us valuable intelligence to turn the probabilities more in our favour about what the price action will do next. And so it's these variances in the underlying volume patterns that are important. And because different currency pairs have a different fingerprint to that pattern, it actually makes it impossible to gain that intelligence without taking those individual patterns into consideration. So here we've seen that this is important even within an asset class, within the Forex currency pair asset class. But next time, we're going to look at what the common repeatable patterns look like for stock indices and commodities. And here we'll see further differences, which means that when analysing volume data, for these in comparison to Forex, it's even more important to take into consideration those differences. Now, just looking ahead one episode further, I'm then going to start to cover techniques you can use to quantitatively assess this relative volume information to meet that objective of informing trading decisions. And this technique that I show you will take into consideration these variances, which is why it's so important we look at what those differences are first. So thank you for your time today. Please do remember to subscribe and also to give me a like. And now until next time, trade safe.